I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction blog, where we kick things off over in Europe, where surging ESG debt sales are helping fuel the best ever start to the continent's market for new bonds. Italy's debut green offering was the most subscribed deal in Europe's primary market through the week. In the States, junk-rated companies setting a first-quarter record this week, roughly $100 billion in sales fueled by first-time borrowers, taking advantage of their rising equity prices. And the high-grade market remaining well open as well, sales topping weekly estimates by a Wednesday, with at least 45 issuers selling more than $65 billion in new debt. Back with us, Krishna Mamani, Gershon Distenfeld and Jim Bianco. Jim, I want to come to you, sir, on the auction slate, on the Treasury side of things. We had that ugly 7-year offering last week, and next week I believe we get 30-year and 10-year debt. Are you worried about the amount of supply coming to market over the next couple of months?
Not really for the next couple of months, because the Treasury has already pre-announced that they're going to pull it back and run down their cash balances. That's actually got me worried a little bit, too, that we might see negative rates at the very front end of the curve. But longer term, just beyond the next few months, yes, because if we get stimulus, we already have a $3.5 trillion deficit. We could be looking at $4+ trillion deficits. And that's a lot of bonds that are going to have to be sold. Maybe not between now and June, but after June, I think there's going to be a lot more bonds that are going to be on the block. And unfortunately, what we saw with the 7-year last week might not be the last time we see something like that.
In a downturn like what we saw through last year, there's a lot of demand for that kind of debt. And I just wonder, Krishna, going forward from here, whether that competition for capital that some people think might materialize in the coming years starts to evolve soon. What's your take on that?
Well, so, if you look at the U.S. real yields, as we talked about earlier, they are significantly higher. So people overseas who need that, need that exposure, need those bonds, we are making more of them. So whenever someone talks about supply and demand imbalance driving Treasury markets, drives bananas. Because that's not what drives Treasury markets. I mean, for an auction, it may, but from a longer-term perspective, what drives the Treasury market is what your inflation expectations are and what the economic conditions are, so that we have an idea as to where both nominal and real yield should be.
Well, Krishna, to put a finer point on it, supply matters. It's what you think that supply will achieve. Do you think this additional supply leads to that growth, that inflation?
Supply certainly matters, but the fact of the matter is that if there is a substantial rise in yields and because of that supply concern, then the equity market will tumble. And then all of a sudden, people who are buying equities will become buyers of bonds. So that eventually works out, and that's how the markets work.
Do you think, Gershon, that high yield's the relative winner here?
Well, the technicals are phenomenal. People are going to need yield. It's important to note that, spreads are not crazily tight. The ultimate yield, the yields are pretty low. And that's going to be the same debate we've been having for a long time. What matters more, the yield or the spread? I would just like to comment one thing on the Treasury market, sure, which is very concerning to me, much more so than the supply, is the liquidity in the Treasury market. We saw earlier this week bid offer spreads on the 30-year go out to like 10 to 12 ticks. That is not something we've seen before. Even the most liquid point, the 5-year point, you would have had a hard time doing more than 500 million at a clip. That is concerning more so than the supply. We need to make sure, if we're going to have all this debt, the Fed's going to be buying a lot of it, we're going to be issuing a lot more of it, there has to be an orderly, transparent, and low transaction cost Treasury market.
Do you think then, Jim Bianco, that's what the Fed needs to be focused on here? The volatility, the illiquidity of the last couple of weeks?
Yeah, I do think that they need to be worried about it. I agree with Gershon. If you look at the history of central banks that do QE, and if you look at the extreme example of Japan, that their central bank, the Bank of Japan, now owns about 45% of their market, where the Fed owns in the low 20s right now. Their liquidity is almost non-existent. They have whole days where benchmark issues don't trade in that market at any great degree, if at all. And that's what usually happens when you get a very large footprint from a central bank in a market. They kind of nudge out everybody else. In fact, we might even be seeing it in the TIPS market right now in the U.S. with some of the liquidity issues that we've been noticing that have been coming in that market because of the heavy involvement that the Fed has had as well, too. So, yeah, you should be very, very worried about the liquidity issues moving forward. They're not going to get better if the economy continues to advance, and they're not going to get better if inflation concerns still are on the forefront of everybody's mind.
If those liquidity issues lead to volatility, doesn't that offer some kind of opportunity as the year progresses, Gershon?
Well, volatility is always the friend of the active investor. So, we've been sitting here for the past few months, not having really strong provocative views. We'd love some volatility. Right now, it's steady as she goes. It's looking at, credits. If you go back to the high yield market, credits that look quite attractive, but the pricing is not great. And we're going to see that for a while. One interesting thing in the investment grade market, which we don't talk about a lot, is for the first time in, I don't know how long, decades, you can buy high quality companies below par. I mean, for years, we were looking at those, old issuance 5-6% coupons that you had to pay $140 price on a bond. Today, you can buy a company like Amazon, for example. You can buy the debt of Amazon in the 80s. And that's because the yields have gone up recently and they've had very low coupons. So there's some interesting convexity opportunities in the investment grade market that we haven't seen in quite some time.
I want to pick up on some of those opportunities. There was a battle several years ago on this program, I'll call it a battle, between Gershon and Krishna over leveraged loans and what would perform better. I believe it was about 2.5 years ago, and I believe I've been informed that Gershon was right on that one, Krishna, that high yield outperformed leveraged loans over the next 2.5 years. As you see things right now, Krishna, what are you more comfortable with, the loan story or high yield?
Well, Gershon won a temporary battle, but he may have lost the war. No, I'm kidding. The point with respect to that is I think credit markets are attractive overall. And I think both loans and high yield are quite attractive. And Gershon was kind of alluding to that. And from a Fed's perspective, from a credit creation perspective in support of the economy, that is a far more important metric than Treasury market volatility, to be honest. I mean, they're worried about Treasury market volatility, but that may have been driven primarily because of repositioning, because everyone was on the same side of the boat. And then all of a sudden they decided to move to the other side with the steepening trade. So credit spreads are quite stable and the Fed is laser focused on it. And therefore, all credit spreads, including loans and high yield, depending on your proclivity, is attractive. I would go back to the original statement that I made to Gershon in that episode, which is loans really aren't about duration. I think if it is about duration, there are 15 different ways of managing the duration of your portfolio. The valuation issues really is more about spreads relative to the underlying credit risk. And I think everything looks pretty good at the moment.
The final word, Gershon.
As much as I'd like to disagree with Krishna, I agree with everything he just said. All credit is attractive. My view 2.5 years ago wasn't that loans weren't attractive. It's that high yield was much more attractive. And quite frankly, they've both done very well. High yield's done better, but they've both done very well. I still think there's a lot of opportunity. And prudent investors are going to look across both markets to figure out where the best opportunities are in each.
That was very graceful, Gershon. Thank you, sir. Everyone's going to be sticking with us. Coming up on the programme, still ahead, the final spread, the week ahead, featuring a slew of US economic data and an ECB rate decision. That conversation up next. This is Bloomberg.